What's going on, guys? Welcome. No, you're back again. Somebody tell this guy to get the fuck out of here. His only job is to tell you to hit the like button.
Why do you gotta be
and
so rude
subscribe
about
to the
it?
channel.
Well, me and my doppelganger do not get along very well, but that's not important. What we need to go over here in this video is one about how the markets are about to come crumbling down and how that is going to be a good thing for AMC. Like we have talked about restricting capital, this is just around the corner. So believe it or not, we are about to see massive margin calls. So let's dive into this video. We're also going to go over all of the typical things we usually do cover revolving around AMC. So let's dive straight into it. And first and foremost, AMC is down about 11% today. Probably discouraging for a lot of people, but keep in mind the volume is still low at about 44.5 million shares that have traded hands. So it's not a high volume day, and the volume being low is signaling to you not very many people are actually selling out of their positions. You're likely seeing a lot of shorting like the ortex data is supporting to us, which we will get into in just one second. But first and foremost, I want to talk about what's going on in the overall markets and how this plays into the liquidity situation that is about to unfold in front of us, which is good for AMC. So just to sum up why the markets are selling off, investment banks Goldman Sachs and Signature Bank, as well as brokers Charles Schwab and Interactive Brokers, began rolling out fourth quarter earnings results early Tuesday. Bank stocks were generally lower Tuesday after falling Friday as the quarter's first round of bank earnings failed to impress investors. So investors were not impressed. And if you guys are unaware of this, inflation is bad, Fed tightening is bad, but that doesn't matter if earnings are still growing. If earnings are doing very well, they can offset each other. The last thing you want is high inflation, Fed tightening, and earnings slumping. So if the earnings start to fall, and we're going to get the quarter results coming out for a lot of the, Teslas, Facebook, Apple, Microsoft, Amazon, your large companies coming out here in the next week or two. And essentially what's going on underneath the surface behind the market indexes is that 1/3 of NASDAQ stocks have slumped over 50%. This is unprecedented, and this is leading us into a bear market, as it does say right here. It's not going to be very pretty. The markets are under this false illusion that things are bad, but it's not all too bad until you really dive under the surface. So this says, as a whole, the technology stock drop of recent weeks doesn't look too bad, with the NASDAQ Composite Index down 9% from its November high. But if you look beyond that number, 36% of stocks in the index have plunged at least 50% from their 52-week highs. And the implications for the markets aren't pretty, possibly a bear market. Historically, when the NASDAQ tumbles or stands within 10% of its all-time peak, only 12.5% of its stocks have tumbled 50% on average. So we are well over the historical average as far as how many stocks are down over 50% relative to the markets only being down about 9% overall. So this has been, I've been talking about this for a long time now. Markets are propped up on weak stilts. Once those stilts go out, you're looking at a full-on bear market. Now, I don't think this crash would be as fast as March of 2020. If you guys were investing then, that was a wild time. The markets pretty much gapped down every single day, like 7 to 10% at a time. But I do think it would be similar to that, and this crash would be very fast, and we would likely stay down for a while, which is good for AMC investors. As we do know, the margin debt is at about $918 billion. So that is very high, up about 100% over the past 2 years. But what is more important that people don't talk about all the time is SBL loans, security-backed loans. And that's where you go to your bank, say, hey, I got $1 million portfolio, and go get a loan on that, usually 50%. Take out $500,000 in cash. So you basically have margin outstanding that you pay 3%. Usually 3% interest on, sometimes higher depending what kind of assets you have, typically 3%. And that does not come up on the margin debt, but that is in between $500 billion and $1 trillion in total. That's a strategy that a lot of wealthy people do, because if you can get a loan for 3% and your money should grow more than 3% per year. So you're basically getting free money. So that's the scoop on that. That is how the margin calls are about to come. As far as the earnings, Apple earnings are on January 27th. That's going to be the most important because, as we do know, Apple has done very, very well over the past 2 months now when the markets have been selling off. Apple has pretty much been on a tear since October and is about 25% higher from its lows in October. So if Apple goes, the markets go. So that's the key, and that's really where this whole margin call theory does rest on, and I think it's ultimately only a matter of time. Other things that are weighing on the market is the Ukraine-Russia situation, where Saki, however you say her name, she came out today and said the situation is worse than it has ever been, that there could be an invasion at any time. They could invade Ukraine literally today or tomorrow if they wanted to, and that's how dire the situation looks. So that's not good as well. That is weighing on the markets, and those are really the key things that are weighing on the markets: earnings and this Russia situation. So that's that for the whole margin call section of this video. Now let's talk directly about AMC, and hopefully you guys understand why that's good for AMC. If you don't, let me know down below in the comment section and I will address those comments and concerns. But more importantly, if you guys want all your questions answered, hop on the live stream in between 10 p.m. and 11 p.m. every single day, and that is Eastern Standard Time. Now, as far as how low AMC can actually go, like I've said many times, I don't expect AMC to stay under $20 per share for an extended period of time, unless we do get this whole market crash situation, market meltdown that I think is coming. I really deep down think it's going to be really April, May-ish. Going to be a great birthday present for me, considering my birthday is April Fool's Day, April 1st. So hopefully I'm wrong on this. I mean, for the general markets, if you're invested in other stocks, it's not great news. If you're invested in AMC, it's going to suck out that liquidity. So long story short, if we do see a bounce in the markets, AMC will also bounce above $20 per share. As far as how low we can go, I would put my bear case, worst case scenario at about $15 per share. I don't see, even during a 20% correction in the markets at this stage, that AMC would continue to sell off at that fast of a pace. $15 would be the lowest I would think, but overall, I really don't expect AMC to be under $20 for all too long. And obviously, it just looks very bearish. MACD looking pretty bearish. The only thing that is bullish, in my opinion, is the low volume, because the question is, do you think volume will come back into the stock? And I think that is undeniable. AMC was searched more than the word stimulus check in 2021. People watch the stock. Even Charles Gasparino said he watches the stock. People pay attention to AMC and they want to make a trade on the MOAS when that actually happens. So I don't think that's a question in my mind, and that's ultimately the question that you should be asking yourselves. If we, for whatever reason, do get a good bounce, watch that 20-day simple moving average in between the Bollinger Bands at about $25.29 per share, and then above that, the 50-day, 100-day, and 200-day moving averages. So the Ortex data, let's refresh this. We're looking at 19.7% short interest of free float, 3% change on the day, 101.08 million shares that have been sold short. Cost to borrow max is coming down just a little bit, but the borrow change is 3 million. So that does make sense. If 3 million shares were sold short today, that would make sense why the stock is down 10%. That's about 10% of, almost 10% of the volume for the day. As far as the share utilization, you're looking at 74.27%, and the days to cover at 2.48. So not too much has actually changed on the Ortex data besides the short interest, which is at its highest levels we have seen since June again. So keep that in mind. The short squeeze aspect of this trade is still very much intact, and regardless what other people say, come to your own conclusions. If you decide to think along the same lines as me, that's fine, but don't let anybody influence your convictions. I certainly don't, and you certainly shouldn't as well. Now, as far as the max pain, we're looking at $22 by Friday, so that would signify about a $4 move to the upside. So who knows if that's actually going to happen. If more earnings, because we're going to start having, 100 companies reporting every single day starting throughout this week, and then hundreds for the next couple of weeks every single day. So that can move the markets around. If they are good, then the markets would bounce, and I think $22 is very reasonable by the end of the week. Ultimately, my price prediction was around $23 to $24 by Friday. Now, as far as the Stocko tracker data, we are looking at 679,000 calls that are out of the money, 61,000 calls that are in the money. In the money puts at 154,000, out of the money puts at 249,000. So that's the same thing as I've been saying. They're double-sided buying power that could come from the market makers. As far as the trade that I'm looking at to hedge out my portfolio, a sneak peek for you guys, I'm looking at Apple. They are up substantially, and Apple, the markets are going to follow what Apple does. So if Apple goes down 10%, markets are likely to come down like 15% or maybe even more. As far as the actual trade I'm looking at the February 18th $135 put. To play that, it's about $30, $37 per contract, and I think that will do a lot of damage. Apple does have earnings on January 27th, so you do get extra time there, and I think it could be very good. As far as other news that you guys need to know, events that are happening, Lucid does have its share lockup period, so I know a lot of you guys have Lucid as well, including me. That could get pretty bloody. Last time the lockup period actually happened was back in November, I believe, and we dropped 19% in a single day. So tomorrow, all pipe investors will be able to sell a portion of their positions, and you can see the stock drop dramatically. I did buy February 18th, $20 puts. Why? Because I want that extra time, so I don't expect Lucid to drop to $20 per share. But if it comes down, say, $5 tomorrow, or 10, 15, 20%, those puts are going to go up dramatically in value, and you should get a couple 100% flip on that. So hopefully you guys found some value out of this video. If you did, hit the like button for me. Consider subscribing to the channel for my doppelganger that always tends to get chewed a new asshole, to be honest with you. So that's gonna be all. If you guys want access to all of my trades, even more than I just said, check out the link down below in the pinned comment for the buy and sell alerts, as well as if you want to support the channel, links for free stocks down below in the description of this video. Love and appreciate you guys. Thank you for watching. I will see you in the next one.